Corporate finance practice problem using Excel. Financing through the issuance of common stock, problem 1. Get ready, it's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab in essence being an answer key. We have the information on the left-hand side. We're going to populate that information into the blue area on the right-hand side. So we're going to be issuing the common stock this time for financing. We're thinking about financing the company. When we think about financing the company, we have the two broad categories we've looked at in prior presentations, the debt side of things. When thinking about the debt side of financing to pull in money for the company, we have to take into consideration the tax impact due to the fact that the cost of debt is usually paid like rent, interest, usually deductible. That's an income statement item, therefore tax impact because we're talking income tax impact. When we look at the equity side of things, we have usually the common stock is what we're thinking of, although we could issue the preferred stock as well. We looked at the preferred stock in prior presentations because it's a little bit easier due to the constraints of the preferred stock. Now we're moving to the common stock, which is a little bit more complex because there's multiple components of the common stock. So now we're talking about the issuance of the common stock in order to finance the company. Note, when we're talking about the cost of the common stock, we're not talking about normal trading that happens on like the stock market. When you see stocks being traded, note that that's usually, of course, being traded from stocks that have already been issued from the company and now are being traded amongst the others on the stock market. Here we're talking about the issuance of new shares in the company, so new shares going from the company. Therefore, when someone buys these shares, the money is going directly to the company, financing the company. Now, obviously, when that happens, we're issuing stocks, which are considered like the ownership portion of the company. So we have to, one, be considering, what the impact is in terms of the ownership, the voting rights and whatnot that could be out there with regards to the issuance of the stock. Then we also want to issue just the cash flow. What's going to be the cash flow kind of impact in terms of the issuance of the stock, and what's going to be the cost in terms of the issuance of the stock with regards to both cash flow, which would be the dividends that we're going to be issuing, as well as the value of the stock, because what has been given up, of course, is the equity interest in the stock, and the value, as the value of the stock goes up, that equity interest could be paid out in the form of dividends, or it could be basically in the growth of the company, which would increase basically the value of the stocks that the owners have. So those are the two things that we got to kind of keep in mind when we're thinking about the cost. So we have the information, and the dividends are something that we're going to have to assume that we're going to be paying. We're going to say on an annual basis at this point, the $2 on the dividends. Dividends in common stock, like with the preferred stock, but different than the bonds, are something that, of course, there's no real end date on. We can think of them going out for a long point in time, whereas there's a maturity date when we think about interest payments on, say, something like a bond. So that's something just to keep in mind. We have the common stock price. This is what we think we can offer them for. So that's how much we're going to be receiving per stock in essence. And then we have the expected growth. That's going to be the 12%. When we give the common stock that now has an equity interest in the organization, they're going to get the dividends, but they also get the increase in basically the value because they're kind of like owners of the organization. So if you think about assets minus liabilities equals the equity interest, they have kind of like an interest in the equity interest. As the equity goes up, then they have that equity interest as well. That's also can be considered kind of a cost there, although you can kind of separate a cash flow situation versus the increase in value depending on what your particular needs are. So we're looking at the cost then of the retained earnings, and then we can also add in the flotation costs. So we'll do it first without the flotation costs, which would be the cost of us to issue the common stock, and then we'll add the flotation cost. The flotation cost hopefully usually would be something that's kind of like immaterial given the amount that's going to be issued, but maybe something that we want to take into consideration when doing comparisons. Okay, so we want to look at this on a percentage basis. That's something that we can basically compare and contrast to some of our other options, such as the debt options. So to do that, let's say that we have the dividends per share. That's something that we're going to have to pay out. That's going to be a cost. So I'll pick up the dividends per share, which is going to be the $2. We're going to be comparing that then to the common stock price. The common stock price we're going to say is the $40. So the $40 in this case is the price, but that's what we expect to receive because we're the ones selling it. So in order to receive the common stock price, in this case 40 per share, then it's going to cost us $2 in dividends, basically on an annual type of basis is the assumption. So if we divide that out, we're going to have a subtotal, we'll call it subtotal, and that's going to be equal to the 2 divided by the 40, making that then a percent and the number group percentifying it. I'm going to go ahead and indent this tab as well, alignment and indent. So there's the 5%. And then we're going to add to that. So that would be basically the cost on kind of like a cash flow basis. But then we got to add to that the expected growth, because the expected growth is something that is also going to be included in the cost. That's what we're giving up to some degree here. So we're also going to say the expected growth is going to be the 12%. So it's going to grow by the 12%, and we're going to say that's annual growth here. So we'll just say number group percentify, and we're going to add then the expected growth to get to the cost of retained earnings. And I'm going to say this is going to be then equal to the 5 plus the 12, 5 plus the 12. Numbers group and percentify that. That's going to be our 17. Let's underline the 12, font group and underline. And so there we have that. We're looking 17%. So here's the formula. And we could make a distinction of the cost of retained earnings, which we're just going to say doesn't include the flotation costs, versus the cost of common stock, which means we're going to include the flotation costs. The formula dividends divided by the common stock price plus the growth rate. So pretty straightforward, but be careful with the formula here that it's not dividends divided by common stock price. In other words, there's no quotations around here. Therefore, we do the division first, order of operations, then we add the growth rate. So now let's say, well, what if we add in the cost of the flotation costs down here? And so we'll tack on the flotation costs. Formula is just going to be slightly different. We're going to say the common stock. The cost of the common stock is going to be the dividends divided by, now we've got the brackets, common stock price minus the flotation costs, and then we will add the growth rate. So it'll be slightly different, same kind of process. So we're going to say the dividends, same point here. We'll say dividends per share. We're going to say is the $2. I'm going to put this into the middle column this time and add one little subcategory to kind of pull this out in our table. And that's going to be the net price. So net price, colon, and this is where we do our little flotation cost, which is going to be the common stock price, the price of the common stock, which we're going to say is equal to, I'm going to put this in the inner column, the $40, but then there's the cost of the flotation cost. So we got to subtract that out. That's the cost of us to issue, in essence, the stock, which we're going to say is $4. That's our kind of one-time cost rather than a cost that's going to be reoccurring, and therefore we're going to calculate the net amount that we would then be getting to issue the stock. So we're going to go font and underline, and that's going to give us then basically our net price, we'll call it, which is going to be equal to the 40 minus the 4. So we're really going to get 36 after this kind of one-time cost, selecting these 3 cells. Alignment, indent, we're going to indent the net price again, indenting that, going to underline the 36. So we're going to go to the font group and underline. Now we're to the same point that basically we had up top. Instead of having the 40, we're basically taking the net, which is the 36 after the flotation cost. And then we're going to add the cost of, we'll make this our subtotal, which is then going to be equal to the 2 divided by the 36. I'm going to percentify that. We're going to say, let's go to the numbers, percentify, add a couple decimals, 5.56, and then we're simply going to add to that our growth rate. So we're going to say growth rate will be here. And also note the difference here between this cost, that being kind of our net price because it's one time, versus the dividends, which is an annual cost. So that's, keep that in mind. And then the expected growth, which we're saying is annual, is going to be that 12%. 12%. Percentify in this cell, numbers group, percentify, underline, font group, and then underline. And that'll give us our end result, which is the cost of common stock, we're going to call it. And that will be equal, I'll use the trusty sum function this time, because that's good to use. Summing those up, or adding them up, and then we'll add the good old percent numbers, percentify, add a couple decimals. We're looking at 17.56 versus the 17 if we take into consideration the flotation costs, the cost of us to issue, the one-time cost of the issuing of the stock.